Welcome, everybody. This is David T. Phillips. I'm the CEO of Estate Planning Specialist, and I'm going to talk to you today about the estate planning and tax planning strategies that we need to implement now as soon as possible because of the current results of the election. And I want this discussion to be as unbiased as possible. So I'm basically going to be a reporter. I'm going to be reporting the news. I'm not going to try to take a stand one way or the other, but I do want you to understand what the ramifications are of a Biden victory and based on his platform and the things that he said during his campaign. So let's where did this all come from? Well, I just returned from the Financial Global Summit that was held in Las Vegas. It's the post-election Global Summit, and I was a speaker there. And after I finished speaking, the attendees came up to me, a lot of them did, and pretty much all of the speakers, and they encouraged me to make sure that what I said was disseminated to as many people as possible. And so I decided to do a webinar on this, and that's where we are today. At the conference, Mark Skousen was there, Hilary Kramer. I really enjoyed just hearing what they had to say and from an investment standpoint. And then there was John Fund, who is a reporter, or actually one of the main editors of the National Review, political analyst for the National Review, and he was there, and he gave us his views on the election and the results of the election. So it was great. It was a great time to be there. We actually got to see the results unfold, at least what we thought were the results unfold right before our eyes. And so, but we need to do a few things right now, and there are some strategic moves that we need to make, and you need to make those moves now. And I'm gonna list in our discussion today 10 strategic moves to make now. So these are 10 moves that you need to be thinking about, or at least some of them you actually absolutely have to do now before the end of the year. And so we're going to talk about 5 different areas of proposals that were laid out there by the candidates. The first one is personal income. We're going to look and see what they said about personal income tax. And then the capital gains tax. So what did they each say about capital gains tax? The inherited IRA and qualified accounts, we're going to spend quite a bit of time on that today because that was it's a very important area. Majority of assets that I see when I do my estate analysis for our clients are in qualified accounts such as IRAs or 401ks. And we want to discuss what the proposals and laws are going to be in reference to inherited IRAs. So that's money that we pass to our children and grandchildren. And then we're going to look at the federal estate tax. That always seems to be a very political issue. And we're going to look and see what the candidate said about that. And then last, but certainly not least, we're going to look at and understand the step up in basis and the implications that's going to have in reference to all of us. So let's get right into it, and let's talk about personal income tax. So really, I'm not too alarmed at the income under $400,000, but we all know that Biden said multiple times, maybe thousands of times during the campaign, that he was going to focus on taxing the rich. And he defined the rich as anybody that makes over $400,000 in a year. And really the tax bracket, the highest tax bracket, is only going to go up about 2 points. So that's not really that big of a deal. But what the big implications were in reference to Biden's proposal is what he intended to do with Social Security tax to that same group of earners. And so if we kind of look at the proposals here that he had stated, is that we would still continue to pay our 12.4% on all our income up to $137,000. That's what we're currently doing. And if you're self-employed, you have to pay that entire amount. So that's a big burden on you as a self-employed. As you know, for me, for example, that's what I have to do. And then once we're at 137 and anything beyond, there's no additional 12.4. So we just pay whatever our normal income tax bracket is at that particular point in time, whatever, filing jointly or separately or whatever. And then, of course, you have to remember you get your state income tax on top of that. But let's just focus on federal right now. So what Biden's proposal is that when you have income over $400,000, so you're a doctor or you have your own business or whatever, and you're pulling out $400,000 of income, that's what you're getting for the year, they're going to throw on or add to another 12.4%. So that'd be 39%. And then in addition to that 39%, another 12%. So actually another 13 is really where it would end up. And that would be on every dollar after 400,000. So that's pretty significant. Really what that translates to, if you're making over 400,000, you could very easily, with your state income tax, pay 60% of that income over 400,000. Any dollars over 400,000 in taxes, and that would be significant. And there are a lot of reasons, justifications for that the Democrats threw at us, especially the AOC group and those. But regardless, that's significant. That's a significant change from where we are right now. So, what's the number one strategy? Well, we call it income harvesting. And with income harvesting, what you're going to do is you're going to want to try to take advantage of the credits that we have right now and the tax brackets, because we are currently at the lowest tax brackets that we've been in 80 years, especially with this group right here. Anybody making under 326, the highest you're going to be in would be the 24% percentage of tax that you would have to pay on every dollar. It doesn't really make any kind of a mathematical sequence sense because you got 10, 12, 22, so it should be somewhere around 28 or 26, right? 28 right here, but it doesn't. It just goes up 2 points and all the way to 326. So we want to maximize that. We want to take advantage of that situation that we've been actually given. So how do we do that? What are some of the strategies that we can do? Well, first of all, we know that if we're not actually making that much money, so let's say our income is $200,000 and we want to get up to that 326. Well, how could we do that? How could we take advantage of that? Well, we could Roth an IRA that we have and get up to that 326. The other things that we can do is we could do strategy number 2, which is the deferred compensation plans that you could set up. And in these deferred compensation plans, what you could do is you could find investments that are actually deductible. So 412E3s, especially the year end, coming here into the year end, if you've got a bunch of income that you want to get out and get back down to the 326 and stay in that 24% bracket, well, here's a 412E3 that you might be able to implement, or some other kind of deferred compensation plan. And IRAs are limited in the amount that you can put in, but you need to take advantage of all these tax deductions that you possibly can have. And the income continues to increase through the years, tax deferred, but it's not tax free. It's tax deferred, as we all know. But tax deferred in periods of time when income taxes are going to be high, it might be a really good idea, because then we can do down here the tax deferred annuity, and we just put money into the annuity. We don't take any money out right now. We just let it cook, let it cook, let it cook. Then income tax brackets lighten up like they are right now, and then we start pulling money out. So again, that's a strategy that you can implement, and anybody can implement that strategy. The tax deductible strategy is a little bit harder for those of us that have regulated income but self-employed can really take advantage of these tax-deductible plans. And then there's the tax-free. Obviously, the optimum option is tax-free. So if I'm pulling down tax-free income at a time when the tax brackets are high, well, I'm in a better situation than those that can't do that. And so I want to take advantage of that. Strategy number 3 then would be the family bank strategy. What's that? Is the family bank strategy. And in that, the family bank strategy uses tax-free life insurance, permanent life insurance, to accumulate wealth for you and for your family and pass on to the next generation tax-free wealth. And my book, my best-selling book, The Family Bank Strategy, is available to all of you for $20. It's on Amazon as well for a little bit more, but you can call in and get the book at the toll-free number here for $20, and I'll actually autograph it for you and send it out to you. But this will help you understand the world of tax-free, and tax-free is much better always than taxable. Okay, let's go to the next area, which is capital gains tax. So now, Biden's proposal really didn't differ much from the Trump. I mean, currently we're at 20%, and it's really actually pretty generous up into the $1 million mark. But once we get to that $1 million mark, all bets are off. And in fact, Biden has said that he wants to get that up to the 39, the same as the income tax bracket, and that would be significant. Not so much for the average year of buying and selling stock and whatnot, but let's just say you decide you want to sell your farm or your business, or you have some stock that you've been sitting on for Microsoft stock that you've been sitting on for years and you want to sell it. You have all of this gain that you have. In fact, if you have a business, your gain could be 100% with a basis of 0. And all of that would be capital gain. And anything over $1 million, so you sell your business for $2 million, the first $1 million would be at 20%, but the next $1 million would be at 39.6%. That would be a game changer. And what it would do would make it so that you would not sell that business during that period of time in the history of the country. You just hang on to it and hold on to it and hope and pray that you could pass it to your kids. Well, there is a strategy that we could implement. Strategy number 4. We could use charities. And specifically, I would not go direct to a charity. I would use my own donor-advised fund. And I would set that up for myself. I would have that in place, and it would be my own charitable organization servicing my own charitable causes that I really, really love and enjoy, and things that I care about. And in that, I would also set up a charitable remainder trust. And the beneficiary of the charitable remainder trust would eventually be the donor-advised fund. What that would do, though, is I would be able to take that appreciated asset. So again, let's just say I bought my stock for $100,000. It's worth $1 million today. There's $900,000 in gain. I would take all of that $1 million and put it into the charitable remainder trust, and then sell it inside the charitable remainder trust. And as such, it would be 100% capital gains tax-free, that sale. So I would have the entire $1 million proceeds to invest. And what it would do is it would create income for life for me and my family, for my wife, for the rest of our lives. And it would also give us a sizable tax deduction. We would give to a charity eventually. They would get it. And there's about 10 really amazing benefits of a charitable remainder trust. The downside, of course, is that eventually when both my wife and I die, Jane and I die, that asset that we transferred into the charitable remainder trust has been sold. So the cash now the asset's out of our estate. It's gone. Somebody else owns it now. And but I disinherited my children because it's going to go to the charity and not to my family. And I don't really want that. So what I do is I implement strategy number 5, which is to replace that asset with a family bank or wealth creation strategy. The nice thing about that is, let's say I transfer $1 million asset. Well, I can replace that $1 million asset with $1 million worth of wealth creation strategy or family bank strategy, life insurance, and most likely a joint policy that pays off when both husband and wife die, because that's when that transfer is going to take place. So it's an excellent strategy to implement. We call it a wealth replacement move, and you set this up into an irrevocable situation so that the proceeds that come out of this do not increase your estate, and your family receives the family bank wealth creation 100% income tax and estate tax free versus the capital gains tax that they might have to pay on an inherited asset, especially if something that you want to sell. If there's an asset out there that you want to sell, and you've got a lot of gain, and this tax bracket goes up, it's going to freeze you, keep you from doing that. This gives you the freedom to be able to do that. Okay, so now let's talk about the next item up for bid here, the inherited IRA, qualified accounts. And I think this is kind of the area that I want to spend a little bit more time than others in, because this particular situation has already come to pass. The Secure Act was put into place, and I believe that it is the new stealth estate tax. Your estate has been looted, and your children and grandchildren have been robbed of the biggest asset in your estate. And I do probably 20 estates a month and analyzing them. And in that, the largest asset that I see time and time again, and the majority, is their retirement account, their IRAs, their 401ks. And that's a terrible asset to pass to the next generation. But it's even worse now that we have the passage of the Secure Act. And it became law. It was a very bipartisan proposition. It unanimously passed the House and the Senate, and President Trump signed it into law on December 20th of 2019. And so here we have this law. What was the big impact? Why do you feel that your beneficiaries have been looted? Well, the reason is because the stretch IRA is now dead. In 2006, we received this beautiful stretch idea where we could take an IRA and pass it to our kids, and they could stretch out the income for the rest of their life. And that would stretch that in, and that would basically allow them to receive something from us forever. Well, that's no longer the case. But before we explain this Secure Act and how it impacts the stretch IRA, let's just understand the qualified account rules of engagement. We all know this, but I want to go over it again real quick. It's, of course, tax-deductible contributions going in. The accounts accumulate tax-deferred, so there's no taxes as it's accumulating. Any withdrawal that we make during the year is total at December 31st. So if we make a withdrawal of $100,000 in June and $100,000 in August, and that's what we took out for that year, we took out $200,000 in that year, and we pay income tax on that withdrawal, full income tax, on April 15th. Why do we pay full income tax? Because it's never been taxed. It's tax deducted going in and tax deferred growing. So it's never been taxed. It's not unfair. It's the rules of engagement. Well, and then if we withdraw before 59.5, they add a 10% penalty on top of that. Now, with the Secure Act, there's a new change. No longer do we do our required distributions at age 70.5. It's now 72. And that's kind of a bone that we got. It really doesn't make a whole lot of difference in anybody's life. Maybe a guy that's, a person that's 70 years old, it might make an impact on them because they were going to have to do a withdrawal sometime. but it's really not going to impact that many people, but it's there, it's in place. So it's now 72 is the new RMD starting point. A spouse still, when they when you pass away, your spouse can receive your IRA 100% tax deferred, so they can take either yours or put it into theirs, and it maintains its tax deferral as it accumulates and compounds. Okay, well then, in March of this year, we had another little sidestep, and because of the coronavirus, we had the Coronavirus Aid, Relief, and Economic Security Act passed. That was in March of 27th. Trump signed that into law. And it really did just one thing that we kind of really need to take note of, and I think most of you know this by now. Hopefully you do. There's no required distributions at all for 2020. In other words, we don't have to take money out if we've reached that 72. And if we are a non-spousal beneficiary, like a child, kids, or grandkids, we don't have to do RMDs at all. So there's no RMDs at all for 2020. Just a side note, I think because the tax brackets are the lowest they've been in 80 years, I think we need to take advantage of that and actually do the RMD or do withdrawals up to that RMD at least for this year. But anyway, that's just me feeling that that's a good way to take advantage of what we have right now that we may not have next year. There's also, if you've been impacted by COVID, especially if you've had COVID or you've lost your job because of COVID and you're under 59 and a half, you can take out $100,000 penalty free. So not the 10% penalty. You still have to pay taxes, but the taxes can be spread out over 3 years. Not really going to impact a lot of people that I know, that I work with, but it's just out there. So you need to be aware that that is an absolute fact right now, that's in place. Okay, so let's talk about required distributions. We know now that they're at age 72, so let's look and see what we have to take out. If we have $1 million IRA at 72, it's 25.6 is the factor, $39,000. But look how it grows through the years. So by age 80, 8 years later, we're taking out $53,000, almost $54,000 we have to take out. Now, these factors may change. There's been some talk of changing the factors and making it so that it's not as much, but but it still remains to be said that we have to take money out of our IRAs and our 401ks. We have to when we reach age 72 now. Okay, so let's talk then about the non-spousal beneficiary, because this is where the big impact has happened with the Secure Act. Again, any withdrawal that they make through the year is going to be totaled up, and at December 31st, there'll be a tax that will be tabulated based on their income. So if I have a child that is making $200,000 a year, and they pull out $100,000 out of my IRA, they have to now report $300,000 for income. So it's added to their top line. Whatever they take out is added to their top line, and that is key for calculation. It's added to their top line. And now the stretch is dead. And so with that death of the stretch, we have what's called the 10-year rule. The IRA and Roth money all must be distributed within 10 years. So they cannot stretch that distribution beyond that. Now, you can take bits and pieces of it throughout those 10 years. You can take it out 10% a year. You could take out 20, 30, 40, make sure. But at the end of 10 years, it all has to be gone and distributed. Right now, though, there's nobody regulating this. Fidelity's not regulating it. Vanguard's not regulating it. It's on your own. So let's say you are gone. You have gone, and you've left, and you're up in heaven right now, and you and your wife are up in heaven, and your kids have this. They're going to be responsible for this 10-year rule. And if they do not obey the 10-year rule, the penalties are very, very stiff. So somebody's going to have to probably step up and be the regulator. But right now, it's kind of on your own. Now, I will say that most IRAs that are handed to kids, to non-spousal beneficiaries, aren't ginormous. They're usually not that big, and so the 10-year rule is not really going to be that big. If you receive a $300,000 IRA and you take $50,000 a year or whatever, it's not going to make the biggest difference in your life. But where I've seen the big impact is in these large IRAs with 2 or 3 kids. That's where the impact is significant. And there's not a whole lot you can do to avoid that unless you do some prior planning. So if you just roll with the punches and go with it, it can be huge and significant. You know, the logic behind the law, to me, makes sense because the R in IRA is retirement. That money was set aside for your retirement. It's never been intended to be inherited by your children and grandchildren. And so as a result, you and your spouse should be spending this money. This should be the first money that is spent. It is not intended to be left to the kids. And therefore, it's really not structured to do it, and you can see the tax impact is significant. So what do? Well, we hoard our IRA money, and we do that because we don't want to run out, but that plays right into Uncle Sam's hand. And an IRA is simply an IOU to the IRS, and the Secure Act accelerates that, and that does that because they want to increase the tax revenue. They need that revenue. They can't really stretch it out. The stretching really didn't make a whole lot of sense in the first place, but now we have to take it out over the 10 years. So you just need to understand that's the rules. And if we just take a quick look at the old rule, if we had $1 million IRA and we were growing at 7% and our kids were at the 30% tax bracket, at the end of 10 years, they would still end up with $1.5 million IRA in the account and would have had about $225,000 of income, paying about $100,000 in taxes on that. I'm sorry, the $322,000 income and netting $225,000. Now with the 10-year rule, if you take it out 10% a pop, so $133,000 a year over the 10 years, you end up paying taxes of $400,000, netting $1 million in income. That's not bad, but you end up with nothing at the end of the day in the IRA. And of course, if you wait until the end to make all the withdrawals, the tax implications are even greater. The key, though, is that with both ways, you end up with zero balance in the IRA, and that's the intention. We don't want to leave, and we don't want to have any money in the IRA at the end of the day. So strategy number 6. Well, should I Roth? Why not take advantage of the tax brackets now and do the Roth? Because a Roth is tax-free accumulation, tax-free distribution, and tax-free inheritance. And you want to try to stay within that sweet spot, that 59.5 to 72. You want to try to and use that bracket bumping, tax bracket management, and take advantage of the 2018 Tax Cut and Jobs Act. You also want to look for tax offsets. So do your conversions into your Roth, but look for an offset. And there's still, right now, oil and gas limited partnerships. Todd, here on our phone number right here, call Todd and ask him about information about those tax offsets that you can take advantage of this year. Okay, but the idea, again, going back to our our tax bracket filing jointly here, we want to make sure that we take advantage of this $326,000 and to stay within that. Look at this, makes no sense. 10, 12, 22, 24, 32. Usually there was a 28 somewhere in here, and we missed that one. And so take advantage of that by doing a Roth conversion. But I think the key is to understand that a Roth is only worth what a Roth is worth. So if I convert $100,000 into a Roth today and I pass away tomorrow, my family gets $100,000. That's what it's worth. Strategy number 7 is to take some of that Roth, not all of it, some of that Roth, and convert it to the IRA Holy Grail, the perfect conversion. And there's actually 6 of these strategies that I wanted to highlight right now in this. The first one is called the RMD leverage strategy. And by the way, all of these strategies are explained in my book, our special report, the Bombshell Battle Plan, and I'll show you how to get that later on today. But and some of you already have it, but there's an updated version that was updated in January. So if you have one since then, you've got the updated version. But anyway, the first one is the RMD leverage strategy. Then the wealth creation strategy, we kind of touched on that earlier. The family bank strategy. The Roth on steroids strategy. So instead of just doing a Roth, you're gonna shoot it with steroids and have it worth a lot more than just the regular Roth. And the IRA reboot strategy. And then the last one is the twist of charity with your IRA. All of those are explained in the special report. But I just want to take a second and just look at the wealth creation one just for a second. And there's a couple of others that we'll look at real quick. We have George and Sarah. And George and Sarah are both age 72. So remember now, they have to do RMDs. They don't have to this year, but again, I'm going to recommend that they do that. They're in good health, and their IRA is $1 million, not unusual today. Their RMD would have been $39,000 this year. 25% taxes, they would have netted $29,000. And let's just say they're going to earn 6.47 in an side in investment with their broker. They have to pay a 1% brokerage fee, and so the net would be 5.47. That's what they would end up, 5.47 netting at the end of the day. Well, let's just look at the wealth creation and family bank, and let's look and see how that compares to just the Roth. Remember what I said earlier, a Roth is only worth what a Roth is worth. So let's look and see that. Here, a Roth, I put in that first year, the Roth would be worth $30,898. But because George and Sarah went out and they purchased a joint and survivor life insurance policy with that $29,000, it created an instant tax-free estate of $1.5 million. They can use that money, the kids can, to pay the estate taxes. It's all going to be estate tax-free. It's going to be income tax-free. It's going to be capital gain tax-free, and that money goes to your kids, to the beneficiaries, and they receive that money, and they can do what they please with it to pay the taxes and basically create an estate for them. But it's worth a lot more than just the Roth. And then a family bank's a little bit less in benefit, but it has way more cash value. And we'll look at that in the Bombshell Battle Plan report. But let's just fast forward to 20 years. George and Sarah are now 92. They've been putting in the $29,000 into the Roth every year. Boom, boom, boom. 20 years putting into it, and the compounding at 5.47 every year. They've never had an 08. They've never had an 01. They've never had a coronavirus year. Everything's been clicking perfect, but they would have ended up with $1 million in that Roth. In 20 years at 92, the wealth creation is still at $1.5 million, still $500,000 more than the Roth account, and the family bank is about $250,000 more. So you have to kind of understand the impact of that this wealth creation strategy really does work, and it's a way in which you can supplement these Roths. So don't just throw it all into a Roth. Use this wealth creation strategy as part of that. Okay, let's look at the Roth on steroid strategy. And I like this one as well because I'm taking now a younger couple. In this case, they're both age 60. Well, David, I want to wait until I'm 72 till I'm forced to take my RMDs. No, don't do that. Take your RMDs earlier, or take some required distribution, take some money out. In this case, you're going to take out $9,000 a year for 10 years, and you're going to pay up your plan. And what it's going to do is it's going to create a $500,000 tax-free life insurance policy for you that your kids can use tax-free to pay the estate taxes the state inheritance taxes, if you live in one of the 19 states that have inheritance taxes, like Washington or Oregon, or to pay the taxes on the IRA when they receive the IRA, or heaven forbid, we have an estate tax again. And you'll also build up cash value. This cash value is your account that you guys can use, you and your husband can use here, this age 60-year-old couple, they can use, and they can use that cash throughout their life for emergencies or for education. I've used mine for education, for investment opportunities that I've had. But look at this here. This is the internal rate of return of that $90,000 that I put in over the 10 years. In 20 years, I'm going to be 80 years old. The internal rate of return after tax is 11%. That means that on that same 90,000, I would have had to pull down 13-14% before tax to equal the rate of return on this with the Roth on steroids concept. So pretty amazing. And your total 90,000 is going to create 500,000 immediately, perpetually. That's 5.5 times what you put in. It's a great leverage. And it allows you to replace what Congress just took away with the Secure Act. In addition, you can add a long-term care rider on this policy. So pretty cool. I really like this strategy, especially for younger folks. Now let's talk about the IRA reboot. This is the last one we're going to talk about here in this of these strategies that we can implement to combat the Secure Act. And this one here we have Irvin, who is 64 years old. He's pretty good health, and he has a $500,000 IRA. In this here, we're going to transfer. We're going to earn some interest in this, and we're going to transfer $105,000 over the 5 years. We're going to put it into the family bank, so we're going to actually do what's called a maximum funded plan, maximum deposit. We're going to stuff the daylights out of this policy, take advantage of the sections 72 of the Internal Revenue Code, and we're going to stuff the daylights out of this policy. In year 2, we're going to take out $25,000 from the policy. We're actually not going to take it out. We're going to use it, the cash value, and we're going to borrow it from the insurance company, and we're going to use it to pay the taxes years 2, 3, 4, 5, and 6. What do we end up with? Well, we end up with a tax-free increase of our estate of $1.3 million. So your $500,000 becomes 1.3, and you let somebody else, in this case the insurance company, pay the taxes for you. So the IRA reboot strategy. So look for it in the Bombshell Battle Plan report. Okay, strategy number 7. The CARES Act. Well, we know that CARES Act was passed in March of this year to combat Corona. And one of the things that you can do is you could give 100% of your adjusted gross income in 2020 to charities. I mean, you know, if you've got a lot, you could do that. You take it away from yourself in the future. You take it away from your kids. You can't put it into a donor advised fund. It has to actually go to a 501c3 organization that does not have your name on it anywhere. A lot of people don't want to do that strategy because they don't want to disinherit the kids. So if they do that, though, they could use that wealth replacement strategy that we talked about earlier in strategy number 5. Okay, let's talk about kind of the big one here, the big enchilada. I really think that the IRA is the one that's going to impact most of us. The Secure Act, that's already in place. Both Biden and Trump agreed to it. It's in place. It's law. This one here is possible. When during the campaign, Biden said that he wants to return the estate exclusion to historic norms. Where are they right now? They're at $11.58 million. That means that Jane and I could pass $23 million to our kids. We could die tonight, and there would not be any federal estate tax if our estate was under $23 million. Well, Biden wants to reduce it back to historic norms. When he was pressed, well, what does that mean? He confessed that it was about $3.5 million. Game on. That puts a lot of us back into the game of estate taxes. The big one, though, and this is kind of the hidden agenda, and I don't know that a whole lot of people have heard about this. Right now, I can gift to my kids the same amount that I could pass to them at death. It's called the gift tax exclusion, lifetime exclusion, and it's at $11.58 million. It's on par with the estate tax. The gift and estate tax are equal. Well, Biden suggests that he wants to reduce that back to where it was before at $1 million. Game changer. That's big, in my opinion. That's going to change everything. Now, let's just kind of look and see what it would look like here. And this is our estate tax from 2009. You look at 2010, we didn't have any estate tax. Remember that? But then now, under Trump, we've had it at $11 million range here for the last couple of years. But in 2021, it would go back to $3.5 million. And most likely it would make it retro to anybody that died January 1st. So this is something that you have to understand, that is a possibility that could actually happen. Don't forget the inheritance tax in those 19 states, too. You've got to remember that. That's added on top of all of this. But if that were to happen, he suggests that he wants the tax bracket to go from 40 to 50. And it would start at your exclusion would be at $3.5 million. But the big part of this would be the gift tax would be somewhere right around the $1 million level. So what can we do? Well, strategy number 8, make gift transfers now before the end of the year. And I know that might be tough for some of you to do, but you need to at least, if you're in this situation, you need to at least look at it and understand what it can do. You got to get on it, though, because right now, what are we? They were November the 18th, and we don't have a whole lot of time. Those exclusions are going to end on December 31st. They're not going to carry forward into the year. And so right now, if you've got an asset with not much gain, because you got to be aware of your basis here. You don't want to lose that step-up basis. We're going to talk about that here in a second. You definitely, though, you want to look at maybe setting up an irrevocable dynasty trust and transferring that asset through a limited partnership and getting that out of your estate. You can retain control. You can retain income. But you just have to be aware of your basis when you make that move. Okay, that's strategy number 8. So let's look now then at the loss and the step up of basis, because that's kind of back to where we were talked about here. You got to be aware of this basis. So let's look at what Biden had talked about. Now, this is a big one. This is a game changer, and there's a lot of things that I've said are game changers, but this one is the biggest of all, because right now we can pass all of the gain that we have in an asset to our kids, and they sell it. They get a step up in the basis, and so they don't have to pay capital gains tax. That's what Trump proposed, and it's the way the law's been for a number of years now. I think 15 years is what we've had it exactly that way. We've had it since I've been doing this for 48 years. And it's pretty much been there the whole time that I've been in the step-up basis. But the way it is right now, it's about 15 years, the way it's been set up. And you're looking at this being eliminated, the step-up in basis. So what that means is that if I have an asset that is valued at $1 million today, and I paid $100,000 for it, and my kids inherit it, they get it at the $1 million value of today. And then they sell it the next day, there's no capital gains tax. And if I'm under the $11.5 million, there's no estate tax. So it's a pretty sweet deal for the kids. They can sell that asset. But if this is eliminated and they inherit it, and there may be some exclusions and whatnot, some limits, but let's just say they inherit it, they would have to gain of $900,000, and they would have to pay capital gains tax. And remember, our capital gains tax brackets back earlier, so that's a deal changer for us. A lot of people have said, well, I've heard some accountants say, well, that's not going to happen because nobody knows what their basis is. You know, Grandpa Moses gave it to me, through the generation 150 years ago. It's in our family. The farm is in our family, or the ranch is in our family, or the business is in our family for 150 years. Well, that's fine. But if that's the case and we can't track the basis, we don't know what the basis is, Biden says, well, I have a solution for that. We'll just make that the basis is zero. And that's just as bad as anything, because that means that all gain would have to be taxed as capital gains tax to those that inherit the property. And they would have to pay capital gains and a inheritance tax as well if they lower that exclusion to $3.5 million. Okay, so what's the solution? Well, here we go. Strategy number 9, set up this wealth creation and family bank. And I really love this table because this shows the most economic plan out there right now today. Is this plan here. I can't disclose the carrier, but it's interesting because you could get a joint and survivor policy for $1 million, do a 10 deposit, pay it up in 10 years. And if I'm 60 years old, I put in $150,000, and I create $1 million instantly and perpetually. And look what my internal rate of return is over 20 years, 12.52 after tax. So it'd be equivalent to about 16%. So this table is available to you. If you call us, we'll send you this table. Or actually, better still, we'll do an individual quote for you and show you how you can implement this wealth creation and family bank strategy in your estate. And why would I do that? Well, because if all of this comes down and Biden is the election holds up and Biden is president and he implements some of these strategies, lowers the exclusion, does away with the step up in basis, you're prepared. You were prepared, and you have this all set up in place for your family. And we set this up so that it's always tax free to the kids, and they use that to pay the taxes, whatever those taxes. They don't have to sell the assets. And by the way, federal estate tax are due 9 months from the date of the passing of the surviving spouse. So there's no, I need an extension. There's no extension. It's 9 months. Now, we haven't had to worry about it too much lately because of the exclusions at $11.5 million, but at $3.5 million, it's a game changer. And we're all back into the game, and we're back involved in it. In fact, I wrote a book called Estate Planning Made Easy. I did 3 editions of it. The last one was in 2003, and I've been asked by a publisher to do my 4th edition. If this all comes down, I'm writing the 4th edition, so look for that one. Okay, strategy number 10, the leverage care solution. Well, again, this is now taking some of my Roth conversion and put it into a leverage care solution plan and take care of our long-term care. This one here, we're doing $18,000 a year. I'm a 65-year-old female. I'm transferring it now, getting it transferred now out of my estate into this family bank's leverage care plan. But look what it does. It gives me $500,000 of coverage, my female 65 years old, $500,000 of legacy benefit. I have plenty of cash value building up in this policy through the years that I can access if I need to. But look what it does for my long-term care. It provides a long-term care pool of $500,000. It comes from the life insurance benefit, but it translates to 2% of that $500,000 is paid out to me over 50 months, $10,000 tax-free for my care. If I use it for 10 months and pass away, my family I would have used $100,000 of it. My family would receive the balance of $400,000. This plan is paid out in an indemnity care, so you get if you can't do 2 of the 6 activities of daily living or you're cognitively impaired, you're drafting from that $500,000, $10,000 a month comes to you in an indemnity, no receipts are required. You get the check, you do what you want with it. You have the kids come over and play bingo with you, and you can pay them for it. Or have anybody care for you. It doesn't have to be formal caregivers. And right now, 82% of all care is rendered by family members, so pay them for it. And especially if they quit their job to take care of you, pay them for it. And you can pay them with tax-free money. They don't have to report it as taxes, and you certainly don't have to report it on your taxes either. So it's an indemnity payout. Pretty cool. This is called the leverage care solution, and it's our last strategy of the day. Well, there's 2 reports that we're offering here today. These are all free. You can call in and get them at the toll-free number down here. You can also go on to the website at epmez.com or to request specifically info@epmez.com for both reports. The Leveraged Care Solution Report was just updated last night, so we've got a lot of new numbers in there, a lot of new concepts. This one here, a bombshell, was updated in January to reflect the Secure Act. And believe me, I took a lot of time getting that one updated and ready for the 2020. I had no idea that, I kind of had an idea that we were going to see a coronavirus outbreak last year because I'd seen it in where my kids live in a foreign country, and I had seen that over there, but I didn't. I thought the United States, just like all of us did, was impervious to that. But anyway, we are where we are, and this Secure Act is in place. There's not anything we can do to stop it, and we need to take advantage of it. So what else can we do? So you can order those reports. You can also call the toll-free number and schedule a time with Todd or myself to start your estate analysis. And let's get your estate analyzed, and let's do the numbers, crunch the numbers for you. Let's look at some of these solutions for you and see how they would pay out. The one I would recommend would be Suite 2, which is the $497. It includes the estate analysis and the retirement analysis, and you get all of those in one binder. Pretty big binder, but you get it all there. It's all laid out for you, and let's get that going. We're kind of cranking these out right now because we have a lot of people that have asked for them, and we're here to help you and give you some direction. Again, call myself or schedule a time with my staff, with our staff, and for Todd and myself. And you can actually even go to info@epmez.com, and there's a way you can schedule an appointment just right there on the internet. Well, we don't have time for questions today because we wanted to close this out at right at about 45 minutes, and I think we're there. So if you do have any questions, feel free to email me, and my email is david@epmez.com, so it's basically the same as this. It's David if you have a question specific for me or for Todd. It's been a wonderful opportunity to speak to you and share with you these solutions. The problems are real, and we need to know what's going on, and I think this has helped. It's certainly opened my eyes as to what possibly could happen here going forward if Biden ends up becoming the president, and I certainly think that that's headed in that direction. So anyway, have a great day, and give us a call if you need us. Thanks. Take care. Bye now.